Good afternoon, everybody. Going to go over our Forex trades for today, Thursday, October 30th. First, just going to touch base on what the Fed did yesterday. They really didn't do anything that was unexpected. Obviously, left rates alone. They did finish QE finally. The last 15 billion is done. They didn't make any statements towards really any big statements about the economy or possibly starting up QE again or anything like that. They did leave the phrase keeping interest rates low for a considerable period of time. So that phrase, considerable period of time, remained in their statement, which everybody wanted to see if they were going to leave it in or if they were going to take it out. That means, so that's basically saying that they're going to leave rates at these historically low levels before starting to raise rates back to normal levels. So they're going to leave them there longer than than people might anticipate, which in a result was positive for the dollar. The stock market viewed it initially negatively. It may have caused some confusion because there's people saying there's a camp saying that the economy's picking up and that rates needs to rise, and there's a camp saying the economy's not picking up, that the rates need to remain low. So there was a sense of confusion in the markets yesterday, carried into today. So the moves were quite capped. Us, for one, we feel that the QE, was really not needed. That it's created. I think we've touched base, and I'll do it real quick. That the Fed has created what we call bad inflation compared to good inflation. Now, bad inflation is inflation that impacts all of us, you, me, everyone else. We go to the store to buy, food. We go to the gas pump for the gasoline. We go to the store to buy clothes and this, that, and the other thing. The inflation is hitting our pockets, the poor, middle class, and the wealthy. It's created assets went up, risk assets as far as stocks and whatnot. They've gone up. So the more money you have in the market, the wealthier you are, the better you're feeling about yourself. But you're still paying higher prices for things when you go to the store. It's created electronic inflation, I guess you could say, because the bankers, they got a windfall coming in. They got all these people coming in that have tried to pay down debt and been savers. They're giving little to zero interest on your account, and they're turning around and they're really not lending out. They're only lending out to the best of the best people that they're going to take chances on for a house or a car or whatever. They're turning around and they're buying government paper and different type of asset classes, very, very conservative, and they're making 1.5%, 2.5% on their money, almost risk free. They're not paying anything out, and that. So that to us is what's called bad inflation. Good inflation would be if the Fed had higher rates, they let rates go back to normal levels. You have to entice, by having higher rates, you're going to entice the banks and the bankers and Wall Street to create jobs by underwriting work projects, roads, construction, housing, bridges, tunnels, you name it. Real type jobs where people have to work for a living, creating things, building things. The bankers, the banks, and Wall Street, those are the firms that underwrite this stuff. They get the stuff done. They float bonds, this, that, and the other thing. They issue stocks when the company wants to go public. That is all what's called good inflation, because that creates real jobs. All right, that's enough of that. So let's go into our trade. We didn't have any signals. Obviously, we're not going to trade going into the Fed meeting. We did have our 1/3 of the euro to Australian dollar, which we've mentioned in every video since we've put the position on the 27th. We finally got out of the last third. We broke it down for you, so it's kind of easy to see. So this was on the 27th. We had the signal 1.44427 area. By the time we pieced in, this was our average price. So we piece in on thirds. So the first third, excuse me, the first third, we were risking up to what we call the average true range, which brought it down to risking right around the 143 level down here. On the second, third, and third, these two here, these two pieces, we're only going to risk 20, 25, 30 pips. So on these two, we ended. You can see here, we basically bought the top. Unfortunately, terrible timing. We got stopped out of this third, losing 21.3 pips. You adjust that for size, it's equivalent to about 7 pips. Same thing on this third, got stopped out at 144.260, lost 21.1 pips, which is equivalent to about 6.9 pips. This last third, we don't have this last third the exact same size as these because we're risking a lot more than normal. Why we're risking more than normal? The average true range has increased on a lot of pairs because the volatility picked up over the last few weeks. Granted, the last few days maybe it dropped off, but the last few weeks the volatility picked up, so the average true range has increased. Between that and the algorithm, it's looking for a greater risk. So we're not going to risk an exact third of an entire position if we're risking, say, 140 pips in this example, 145 pips. So we cut this third, even though it's a third of the entire position, this third is not equal to these two, okay? It's not equal to this, it's not equal to this one. So this third is approximately half of these because we're risking a ton. Normally we would risk on this last third, normally we're going to risk 80 to 100 pips, 60 to 100 pips. So that's going to be 20 to 30 pips. So on an entire position. So this, and since we're risking 140 pips, we cut it down in half. This was the huge pop yesterday from the Fed announcement yesterday afternoon. So we didn't get stopped out. It ran up and tried to break the figure 144. We held it this whole time. It finally last night, around 8 o'clock or so, it finally broke 140, the figure of 1.44. Ran up to 1.4409. Couldn't get through it. It tried another time, which we were thinking, man, this is going to run right here. Because it's fed by it's being fed by the fuel. The fuel is the Fed that hopefully would make it run. Stalled out the same spot, and that was a bad sign. Once we saw it stall out, a bad sign. We gave it a little bit more time. It couldn't get. It tried to get through the figure 1.44 2 more times. Another hour or so. And when we saw that, it was key to get out. We ended up getting out 1.43896. We lost 53.1 pips. Size adjusted, it's about 8.8 pips. So overall, between this is just one trade, we lost 22.7 pips. But this one trade was from the 27th of October, 3 or 4 days ago. So, you hate to get beat up, but we've been doing pretty well. It's not even getting beat up. You got to give these things room to trade, to wiggle, and that's what we always do. Especially by piecing in the original first third we purchase, that's the one that we give a lot of wiggle room. Many times these things, they'll come down like this, they'll jiggle, and then they start to run, or they come down, they jiggle, and then they start to run because of a news item or whatever, and you can make a ton. Unfortunately, it didn't happen for us on this trade, but we stick with our strategy, and that's what we do, and it's successful. So anyway, one trade lost 22.7 pips. That's it. No scalp trades. We didn't do any scalp trades this morning. And no other signals. There were a couple signals that came out after the Fed meeting yesterday, after the Fed announcement, but neither one of those has been triggered yet. They're still open orders, just haven't been triggered. Anyway, that's it. We're going to wrap it up. If you're still trading now, good luck. If any signals come out, they'll be coming your way, and we'll be back tomorrow, assuming we get some action.